Imagine waking up one morning to find that every stock you own has dropped by half. The news is chaos. Experts are shouting, fear fills every corner of the market. And yet you do nothing. You don't panic, you don't sell, you don't chase safety. Instead, you sit quietly, confident, knowing that your plan is working exactly as it should. That calm, that discipline, that clarity, that's the difference between the gambler and the true investor. Because investing isn't about predicting the next big win, it's about understanding the timeless rules that never change. And today you're about to learn the 10 principles that separate those who hope for wealth from those who build it slowly, steadily, and unshakably. In the world of investing, what shines brightest today often fades tomorrow. The markets have a way of humbling enthusiasm and restoring balance. And that is what reversion to the mean really means. When a fund or a stock races ahead, investors get swept up in the story, convinced that this time is different. They forget that markets move in cycles, that excess performance eventually corrects itself. The company that was the darling of Wall Street, the fund manager who seemed invincible, both are subject to the same gravity that pulls everything back toward average results over time. It's not pessimism, it's simply the rhythm of market. The danger lies in believing that the recent past will continue indefinitely. Investors often chase what has already gone up, thinking they're stepping onto a fast-moving train, but in truth, they're usually boarding just before the brakes screech. By the time the headlines celebrate a winner, the easy gains have already been captured. The smart investor, instead of running toward what's hot, steps back and asks, is this sustainable, or has the market simply overshot? Recognizing that high performance tends to cool off and that lagging areas often rebound is a mark of discipline, not doubt. The path to lasting success isn't paved by predicting which sector will explode next, but by understanding that nothing grows to the sky. Every boom has its lull, every leader its slowdown. Markets reward those who see this ebb and flow not as noise, but as opportunity. When others chase excitement, patience becomes a competitive advantage. Reversion to the mean reminds us that in the long run, fundamentals, not fads, win. So temper your enthusiasm, trust the averages, and let time and balance do the heavy lifting. The most powerful force working in an investor's favor is time. Time turns small beginnings into meaningful wealth, not by magic, but through the quiet miracle of compounding. When you allow your investments to grow undisturbed, the returns you earn begin to generate their own returns, building layer upon layer of growth. It doesn't happen in months or even a few short years. It unfolds over decades. The beauty of compounding is that it rewards patience more than brilliance. You don't have to predict the market. You simply have to stay in it long enough for time to do its work. But the enemy of this process is impulse. Every investor feels it, the urge to act when the market trembles or when headlines shout about the next big thing. Fear and greed are powerful emotions. They whisper that you should sell before things get worse or buy before it's too late. Yet every rash move steals a piece of your long-term return. The investor who jumps in and out of the market chasing comfort or excitement ends up cutting down the compounding tree just as it begins to bear fruit. The results might feel good in the short run, but over time they destroy what patience could have built. True investing success isn't about timing the market, it's about time in the market. Endure the storms, ignore the noise, and remember that the market's greatest rewards go to those who give it time to mature. Every day your money stays invested, it's quietly working for you, reinvesting dividends, capturing growth, and building momentum. So resist the impulse to react. Let time, the most reliable ally an investor has, do the heavy lifting. In the end, patience is not just a virtue, it's a strategy. Buying right is the foundation of sound investing. It begins with the recognition that no single company, industry, or manager holds the secret to endless success. The market is unpredictable, and even the best businesses face storms they can't control. That's why the smart investor doesn't gamble on one idea, but owns a broad slice of the entire market by holding many companies, large and small, across sectors and geographies. You allow the strength of the winners to outweigh the weakness of the laggards. Diversification doesn't promise excitement, but it offers something far more valuable: resilience. Once you've bought right, the next rule is to hold tight. The world of finance is noisy, full of experts predicting rises and falls, urging you to act. But wealth grows quietly, not by constant movement, but by consistent holding. The investor who clings to their plan through thick and thin, who resists the temptation to trade at every headline, captures the full benefit of long-term growth. Markets may stumble, but history has shown they recover. Those who panic miss the rebound. Those who stay invested collect the reward. Realistic expectations complete the picture. Investing is not a get-rich-quick pursuit. It is a lifelong process of building value. Expecting the market to deliver miracles sets you up for disappointment and bad decisions. A reasonable return, steady, compounded over years, is enough to transform modest savings into lasting wealth. Chasing extraordinary returns often leads to ordinary results, or worse, devastating losses. True investors understand that slow and steady is not boring, it's powerful. When you buy broadly, hold faithfully, and keep your expectations grounded in reality, you align yourself with the enduring rhythm of the market, the rhythm that turns patience into prosperity. Every investor dreams of finding that one perfect stock, the hidden gem that will soar above the rest. The financial world feeds this fantasy. Pundits proclaim the next big winner. Analysts publish lists of must-own stocks, and stories circulate about those who struck gold with a single pick. But what we rarely hear are the thousands who guessed wrong, who chased the needle and missed. The truth is simple and humbling. Finding the needle in the haystack is nearly impossible, and even when you do, holding it long enough to benefit is harder still. The wiser approach is to buy the entire haystack. Instead of trying to outguess the market, you can own the market itself. Every company, every industry, every opportunity. When you hold the whole haystack, you guarantee that you own the winners of tomorrow, even if you can't predict who they will be today. This approach may not sound exciting, but it is the foundation of real lasting success. Broad diversification in action, turning uncertainty from a threat into an ally. By owning the whole market, you remove the burden of constant decision-making. You don't have to worry about which stock will outperform this quarter or which fund manager will fall short next year. You participate in the collective growth of all businesses, benefiting from the power of capitalism itself. The haystack strategy doesn't rely on luck. It relies on discipline and faith in long-term progress. The markets will have their ups and downs. Individual companies will rise and fall, but the broad market over time is always advanced. Forget the illusion of finding the perfect stock. Own the haystack, stay the course, and let the market's natural growth reward your patience and simplicity. In the grand casino of Wall Street, every trade, every fund, and every bit of advice comes with a cost. The difference between a great investor and an average one often isn't found in brilliant timing or superior stock picking. It's found in the quiet, consistent discipline of minimizing costs. Every dollar you pay in fees is a dollar that no longer works for you, and over years those small costs compound into large losses. What may look like a modest 1 or 2% fee each year doesn't sound alarming, but when stretched across decades, it becomes a mountain that eats into your wealth silently. Think of your investment return as a pie. The market bakes the pie through growth and dividends, but before you can enjoy it, the financial intermediaries, fund managers, brokers, and advisors take their slices. The more slices they take, the less is left for you. Many investors never realize how much is lost this way because the system disguises these costs in fine print and percentages. Yet the effect is devastating. A high-cost fund has to outperform its low-cost alternative just to break even, and most never do. Keeping costs low doesn't mean rejecting professional guidance or modern tools. It means being conscious of what you're paying and what you're getting in return. It means understanding that simplicity, broad market investing at minimal expense, beats complex and costly strategies over time. The market's returns belong to you, not the middlemen. When you strip away unnecessary fees, you free your capital to compound fully, working harder every year on your behalf. The surest way to maximize your share of the market's growth is not by seeking miracles, but by refusing to surrender what's already yours. Control your costs and you control your destiny as an investor. Every investor must come to terms with a truth that's often uncomfortable. There is no such thing as a risk-free investment. Every choice you make with your money carries trade-offs. Even the decision to do nothing, to hold your cash in a savings account, has a hidden danger because inflation silently chips away at its value. $1 today won't buy a dollar's worth of goods tomorrow. Playing it safe by avoiding risk altogether may feel comforting, but in the long run, it can be the riskiest move of all. The real task isn't to eliminate risk, but to understand it, measure it, and manage it wisely. Markets rise and fall. Economies expand and contract and prices fluctuate. It's all part of the natural rhythm of capitalism. Volatility can be unsettling, but it's the price of admission for long-term growth. Without accepting some level of risk, there can be no meaningful reward. The key is to take risks that are appropriate for your goals and temperament. That means holding a diversified portfolio that balances potential returns with the stability you need to stay invested through the storms. What destroys investors is not risk itself, it's the reaction to risk. Panic, overconfidence, and emotion are far more dangerous than any market downturn. The investor who understands that losses are temporary but fear-driven mistakes can be permanent will always have an advantage. Accepting that risk as part of the process brings clarity. You begin to see market declines not as disasters but as opportunities to buy at better prices. Risk is not your enemy. It is the engine that drives return. The art of investing lies in respecting it, never denying it, never fearing it, but learning to live with it intelligently and patiently over time. The market is a living, breathing reflection of human progress that evolves with every innovation, every policy change, every shifting global behavior. Yet, many investors make the mistake of fighting the last war, believing that the strategies, sectors, or trends that won yesterday will keep winning tomorrow. History is filled with examples of this error. Once it was railroads, then steel, then oil, then tech. Each generation of investors falls in love with what has worked and assumes it will always work. But markets, like life, refuse to stand still. What was once a golden path becomes a trap for those too stubborn to adapt. The problem is comfort. Familiar patterns make us feel safe. When a certain approach succeeds, we anchor ourselves to it, thinking it will shield us from uncertainty. But the market rewards adaptability, not nostalgia. The economy that defined the last decade is not the same one shaping the next. Technology disrupts industries, demographics shift demand, and policy can rewrite entire playbooks overnight. The wise investor respects the past, but doesn't live in it. Instead of clinging to old victories, focus on timeless principles, diversification, patience, cost control, and long-term perspective. These do not change even as the world around them does. The specifics of what you invest in may evolve, but how you invest rationally, consistently, and humbly should remain constant. The danger of fighting the last war is that you end up defending ground that no longer matters, while opportunity passes by. Look forward, not backward. Markets move with the future, not the past. The investors who understand that progress, not memory, drives value will always find themselves on the right side of history, quietly compounding as others chase yesterday's glory. In the world of investing, cleverness is often overrated. There's always a new theory, a new strategy, a new voice, promising to outsmart the market. The fox darts from one idea to another, trading today, timing tomorrow, chasing trends the day after. Looks impressive, but all that motion rarely leads to meaningful progress. The fox confuses activity with achievement. In contrast, the hedgehog understands one big truth and lives by it. It doesn't need to be clever because it's consistent. It focuses on a few timeless principles and refuses to be distracted by the noise. The secret to lasting success isn't found in complexity, it's found in simplicity. Owning a broad, diversified portfolio, holding it through every storm, keeping costs low may sound dull, but that dullness is what produces real wealth. The hedgehog investor knows that markets rise and fall, headlines excite and frighten, and new products come and go, but the underlying power of disciplined long-term ownership endures. There's nothing glamorous about it, and yet it quietly outperforms the majority of those chasing brilliance. The temptation to act like the fox never goes away. The financial world constantly sells sophistication as superiority, but history proves otherwise. The more complicated the strategy, the more fragile it becomes. Simplicity, on the other hand, compounds strength. The hedgehog's advantage is focus, doing the right thing over and over without getting distracted. By embracing simplicity, patience, and discipline, you align yourself with the way markets truly work. While the fox is busy predicting tomorrow, the hedgehog is quietly building wealth. In the long run, it's not intelligence or innovation that wins, it's consistency, humility, and faith in the enduring wisdom of staying the course. The greatest challenge in investing isn't understanding the market, it's mastering your own emotions. When prices fall and headlines scream panic, the impulse to run feels overwhelming. Fear whispers that this time is different, that the system is broken, that selling now will spare you further pain. And when markets soar, greed takes the stage, convincing you that gains will never end, that you're missing out if you don't jump in with both feet. These cycles of emotion, fear, and greed are the twin destroyers of long-term success. They lure investors into buying high and selling low, repeating the same costly mistake over and over. The antidote is simple but not easy. Stay the course. It means having a plan before the storm hits, and trusting that plan when the winds blow hardest. Markets have always stumbled, sometimes violently, but they've also always recovered. The investor who abandons ship in a downturn not only locks in losses, but often misses the rebound that follows. Those who stay invested, who ride through the turbulence, capture the full benefit of the recovery when it comes, which it always does. Staying the course requires patience, courage, and faith in the long-term power of markets. It means accepting that volatility is not a threat, but a companion on the road to growth. Success doesn't come from perfect timing or clever predictions. It comes from steady conviction. The market rewards those who endure, not those who react. So when fear rises or excitement tempts, remember your purpose. Your greatest advantage as an investor isn't your intellect, it's your temperament. Staying the course may sound ordinary, but in a world that constantly urges motion, doing nothing when done wisely is the most extraordinary discipline of all. The most successful investors are not the ones who boast about perfect timing or claim to see the future. They are the ones who approach the market with humility. Investing is not a contest of intelligence or bravado. It is a lifelong partnership with uncertainty. The market doesn't bend to anyone's opinion, and it certainly doesn't reward arrogance. Accepting that you cannot predict its every move is not weakness, it is wisdom. The humble investor knows that patience and discipline will accomplish far more than any attempt to outguess the crowd. Perseverance is what turns small, steady efforts into extraordinary results. Saving regularly, even modestly, builds momentum over time. Each contribution becomes a building block, each reinvested dividend, another layer of strength. The process may seem slow, but compounding works quietly, almost invisibly, until one day it reveals its power. Those who quit too early never see that moment. Those who persevere are rewarded not because they were lucky, but because they were consistent. The temptation to intervene, to tweak, adjust, or jump in and out is constant. But the truth is that markets reward those who let them work. You don't need to chase what's popular or react to every headline. You need to stay steady, let your investments grow, and trust the long-term progress of business and productivity. Humility keeps your ego in check. Perseverance keeps your strategy alive. Together, they form the mindset of a true investor, calm, rational, and focused on the future. The path to wealth is not paved with brilliance or luck, but with steady steps taken over many years. In the end, success belongs not to those who try to outsmart the market, but to those wise enough to let time and discipline do the work. Let me say this, investing is a skip in the river of time, not a sprint. Your goal is not to beat everyone tomorrow, but to serve yourself well 30, 40 years from now. When you apply these 10 principles, respecting time, controlling costs, embracing simplicity, sticking to your plan, you place yourself in the company of ordinary people who have built extraordinary futures. So go forward today with your plan in hand, stay humble, stay persistent, and let the long run work in your favor. Thank you for your attention, and may your investing journey be patient, resilient, and rewarding.